more about one of the things. So this is your second time on the podcast. One of the things we talked about in depth quite a bit was options. That's sort of another area that I think traditionally has a lot of speculation, but definitely not the way that you're using it. And we got talking at, I think it was the Guy Spear William Green meet and greet in Omaha about like this story with your experience with JD.com, where you're putting up, I think, relatively small amounts of capital, or you'll be able to explain it to us. But what's the story with JD.com and that experience of I think was selling puts, buying calls?
It's a very good question. So JD.com sells an ADR in America, which allows us to buy it quite easily through the standard market. You can buy it through the New York Stock Exchange, but part of our strategy is to purchase things for the lowest price we possibly can. And so we use a structured value approach where we write a put as a tool to own the underlying equity. There was a legal issue. So JD.com has a number of warehouses and done all the logistics, and is similar in many ways to an Amazon and a FedEx here in America, existing over in China. And at one point, the CEO got in some trouble. It was like headline news, and the share price was plummeting. Part of the Black-Scholes model is volatility. So volatility kind of feeds into the price of these option contracts. And when volatility is very high, the premiums of both puts and calls go up because there's more uncertainty. People want more premium for the perceived risk that they're taking. The way that we use these is very different than the way that most of the market uses them. So as people are speculating or trying to sort of buy a call to sort of leverage their gain, or they're trying to buy a put because they're scared of a security, so they're buying a put when they're fearful and they're buying a call when they're really euphoric. We're taking the opposite side of that trade. So as there were these headline risks and exposure for JD, the price fell way below what would be even a reasonably consideration for a intrinsic value of JD. And during that period, it was an interesting time. It was almost it's a pretty advanced approach, but instead of just selling the puts, where we picked up an enormous premium, we were selling out of the money puts. We used a little bit of that premium to then turn around and buy some out of the money calls, because these went out a couple of years, and we had a long time horizon. We're very patient investors, but we basically were able to purchase these calls ultimately for free. So we took the put premium in, we bought a few out of the money calls, and by the time the calls had expired, the shares had gone from about $20 a share to $90. So we had a certain amount, maybe a 8% exposure in our fund, but those calls went up, just an enormous amount. And so, we end up with a great return. In fact, we had exited with covered calls before even the original calls had converted to stock. So we basically did the whole transaction over about a 2+ year period. Wow. And it was sort of infinite return because we didn't put any capital up. Yeah. But
that's crazy.
It was a small position that turned into a very reasonably sized position, and was sort of just free money.
Wow. And did you end up getting put any of the shares, or did it?
We were not put any of the shares.
It was basically just moving up, so you weren't put any of the shares. You just took the premium. And then the premiums actually covered the entire premium of the call options you were buying.
That's right.
That's insane.
And without getting into too much detail on it, there's a lot of controversy around. It's a controversial sort of topic, but in my view, you can do pretty much the same thing with BABA right now. So, because volatility is so high, and because contracts go out multiple years based on a number of different parameters, if you're comfortable with the risks and things that you're taking in terms of political risks, et cetera, I think you're in a good position to pull off something similar with BABA.
Right. Okay. And then typically when you're writing these put option contracts to kind of enter a position, how are you kind of structuring that? Are you doing kind of like staggered over different time periods, some in the money, some out of the money? Like what does that kind of look like for your fund?
So it's such a good question because as you start applying this rigorously, you start to realize that you get all sorts of ways to sort of diversify and almost cost average through these products. So you can adjust your strike price. You can adjust the premium that you're willing to accept, so you can sell for a variety of prices. You can also adjust your expiration date. So if you, so ultimately, I end up building sort of a three-dimensional matrix, and we're selling things with different strike prices, 4 different prices that expire at different times. And if there's a contract that, say, is going to expire with a strike of 100, and we have contracts expiring in 3 months, 6 months, 12 months, and 24 months, we may end up with some where we buy and some that expire and we don't buy. And what that means is ultimately, within that same position, we've really lowered our cost basis down to a very low price per share. So if we're trying to buy 1,000 shares, if we're willing to buy 1,000 shares, but we end up with 500 of those shares, we may have picked up $20 in premium on each contract. So it's sort of become, if we pick up only half, we've now sort of picked up 40 on that half. So instead of buying for 100, if that's the market price, we're in for 80, or maybe we're in for 60. But it's a very valuable tool. So we structure it with this sort of matrix in mind, where we take our full notional exposure that we'd wish to have, and at the end, as things expire, we can always write more contracts if it still provides us with adequate IRR.
Yeah. Okay. And obviously, I think with option contracts, they're in buckets of kind of 100 shares. So this is probably having the three-dimensional matrix that you're talking about is something that kind of comes with some level of scale, I guess. Was this something that, I think your fund started with $100,000 a few years ago? So were you still using put options? And of course, I would imagine that the matrix wasn't as complex, but how did you kind of go about structuring your put options when you were relatively smaller?
That's a great question. So we did launch. We launched with 125,000. Within a few months, we had over 1 million and that type of thing. But even with 1 million, it's sort of difficult because you're let's say you're willing to have only 10 positions, you still need to allocate 100,000, which, but you can build out the matrix with that size, as long as you're dealing with. It depends on the price of the underlying stock. So if you're dealing with a Berkshire or a Google or Netflix or Tesla, your notional becomes very large because the price of the underlying shares are expensive. So you can do it with one put contract, though. You don't need to wait till you can build out the whole matrix. If you want to buy the shares, I started implementing this in about 2005, and it happened very organically for me. I was working out on Wall Street, and I was working with all these different trading desks at Goldman Sachs, trying to work out these models and things for them. And I just recognized that it was so silly to buy through the New York Stock Exchange when I could sell a put contracts and get put the shares. So it would just make it, I could just buy it for less than the retail investor. And I didn't have millions of dollars back then, so I was doing it with a small amount of capital, and I would just simply sell 1 or 2 put contracts on the shares I want to hold, and it still wasn't any form of speculation. Once we receive the shares, we're long-term buy and hold investors, just like Warren and Charlie, and so we're building out this portfolio. We think of ourselves as owners, and we'll hold those shares for a long time. But even with one put contract, there's an advantage. You lower your cost basis below the retail price of a stock.
Mm-hmm. Right. And you're typically doing selling calls on the way out as well to sell for a higher price as well.
That's right. So in a again, just sort of generic scenario, if instead of it costing 100, you get a $20 premium and it costs you 80, when those shares go up to 400, you, instead of selling for 400, can now turn around and maybe sell with a strike of 450 and pick up another $30 and be out at 480. Mm-hmm. So the shares may never go to 480, and they maybe never dropped all the way to 80. But and I'm sort of trying to create easy math for myself. But instead of buying for 100 and selling for 400, you'd make 300%. Instead, you're in for 80 and selling for 480. I guess you'd make 500%, like 6x, right? So there's a very real tangible advantage. I mean, your portfolio, if you had $1 million, instead of it being now 400 million, now it's 600 million. So it's real money.
Crazy.
It's mind-blowing.
Yeah,
I highly recommend you implement this in your own portfolios.
we were talking about this last night, and Hamish has been digging into Netflix a lot lately.
Yeah, it's kind of been a bit of a rabbit hole for me. I was because I think as I said, I'd heard about this strategy from a couple of different people. Phil Town's spoken about it, and a few other people mentioned it to me that I should be looking into this, and I never really kind of gave it any thought. And then I watched a couple of your videos, and your explanations just kind of. I think through your podcast as well, just kind of resonated with me. And like yesterday, I was just kind of staring out the window for like just running numbers. Like, okay, if the stock goes to here, this is what happens. If the stock goes to 0, this is what happens. Just kind of running it through. So, it's really fascinating.